Welcome to the 7th edition of our podcast series, Talking Data, which offers timely insights into macro data and its impact on the economy and markets. I'm Kristen Radish of Arbor Research and Trading. I will be today's moderator. Our podcast features Jim Bianco of Bianco Research. In today's installment, Jim will provide his insight on the bond market. Jim, it seems like nothing moves the bond market anymore. Just how quiet is it?
Yeah, it's been amazing what's been going on in the bond market. Let's take the 10-year yield and the range of the 10-year yield. If you take 65 basis points, which as we talk right now, it is at 66 basis points, plus or minus 10 basis points, that's pretty much defined the range except for a handful of days since April. This is the tightest range that we've ever seen. Or if you want to look at it in a different metric, the MOVE index, the Merrill Option Volatility Estimate, which is like the VIX of the bond market, hit its all-time low last Friday. Yesterday, it hit its second lowest level ever as well, too. So the volatility in the bond market and the ranges have been extraordinarily tight for months. And what's made this interesting is you could say, all right, there's quiet periods in markets. Well, there isn't in anything else. Commodity prices, which typically move in tandem with interest rates, they move up and down together. You can't predict one over the other. They kind of go the same time. Commodity prices have been moving up sharply, especially industrial commodities like copper. That should put upward pressure on interest rates. Hasn't moved them an inch. What about volatility in other markets? If the bond market's making all-time lows in volatility, that's not the case in the stock market. It's actually been very elevated volatility in the stock market as well too. When the September 2nd, when the S&P had its all-time high at 3580, the VIX index, its volatility measure, closed at 2680. That's the highest level ever on an all-time close for that metric, meaning that the bond market has been anticipating a lot of volatility. Forex volatility, that's also very elevated as well too. So if you look at the market, it's been a very tight range. It's been record low volatility for the bond market. Should it be? Well, you've got commodity prices suggesting rates should go up, and you've got a lot of volatility in other markets as well, too. So to use the old Sesame Street thing, one of these doesn't look like the other. That's the bond market compared to all of most of the other financial markets.
So why is it so low?
Yeah, I think there's 3 or maybe 4 reasons why it's so low. I think the big one is the Federal Reserve itself is the biggest buyer of bonds. It has bought over 3.2 trillion with the T dollars of bonds since March. It's bought of that measure, almost 300 plus billion of it has been Treasury inflation protected securities or TIPS. It has been the largest buyer of corporate bonds. It's been the largest buyer of corporate bond ETFs. So the bond market has been dominated by the Federal Reserve's actions. That buying, I think, has really squashed out a lot of the volatility. A lot of people have made the case that maybe interest rates are at an unnaturally low level, that without the Fed purchases, they would be higher. I'm in that camp. And since they represent an overvalued state, nobody really wants to own them at these levels. So you've chased everybody out, and all you've got left is the Fed kind of controlling that market. The other thing that's helping keep volatility low is at least what we refer to as the forward guidance by the Fed. They've all but promised us that they won't raise interest rates for at least 3 years. Now, whether that happens or not remains to be seen. We'll talk about that in the next section, whether that'll happen. But the fact of the matter is they are sending a strong signal, hey, we have no intentions of raising rates for the foreseeable future. So that removes a lot more of the uncertainty in the market as well. And the Fed has also talked about yield curve control. I think we actually de facto have it. Yield curve control, let me put this in blunt out. It's price fixing. It's the Federal Reserve fixing the price. They're saying that the 2-year note should be 10 basis points. And then they will buy and sell 2-year note securities to just make sure that it just stays anchored at that. Or that they say that the 5-year note should be at 25 basis points. And they buy and sell securities to just anchor it at that level. That's yield curve control. I think in essence, this massive amount of QE has been de facto yield curve control. So you put all of those into the mix, that's really squashed down volatility. And the last one, and I'll talk about this in the next section a little bit, is for the moment, inflation is low and very quiet. Inflation is a volatility event for the bond market, but for the moment, we don't have any.
So really, what's going to get it moving?
I think that there's two possibilities that could get it moving. One in yields down, and the other in yields up. In yields down, I think that would probably be some kind of a, I'll use the Wall Street vernacular, a big risk-off event. Maybe a reinfection wave similar to Europe, or some kind of slowing in the economy. The 10% correction in the stock market that we've witnessed to date becomes 15, becomes 18, and then you have a flight to quality into fixed income securities. Yeah, they may not represent value, but if I put all my money into treasuries, I might lose 0.5% or 1%, but I won't lose 20 like I could in stocks. So you could get that kind of a event that would cause interest rates to go down. Now that's predicated on the economy turning south, the stock market decline picking up steam as well too. But the event that could turn it north, I think, and that is rates higher with more volatility, I think is more plausible. And that starts with you get a vaccine, you get some kind of a recovery in the economy. You've already stimulated the hell out of the economy, and that's a technical term. And then you throw on top of that a vaccine. All right, everybody back in the pool, everybody back to work, get back on the trains and the subways. Let's all go back. Well, you've already stimulated it. You add that on top of it, you could see the economy really roar forward in that environment, and that would push rates up. Or you might just have a fear of a return of inflation. I'm in that camp. How do we get inflation to return? Two things. First of all, the dynamics. You have had the worst recession since the Great Depression. Maybe it's over. We've been talking about that in the last couple of days, the collective of the markets, that is. And that might be the case, but it was still the worst. And right now, economic activity now is lower than it was a year ago. Less people working, less stuff being made. You've stimulated. You've sent $1,200 checks to people, $600 a week for the unemployed, bailouts for cruise ships, bailouts for restaurants, bailouts for airlines as well too, to keep the demand for those products as high as possible. Less supply, stimulated demand equals higher prices in the future. That's known as inflation. So if you were to get inflation and the fear of inflation, that could start to move rates higher. One last thing about inflation. Right now, it's 1.5% or so, and I'm thinking core PCE, which is the Fed's favorite metric, core meaning less food and energy. I think inflation is defined as 2.5%. That would be the highest level in 27 years. 1993 was the last time we were really that high on core at a sustained level as well too. So you don't need 4 or 5 or 6% inflation like you had in the 80s. You just need it to get to 2.5. And a lot of people, to this day, a lot of people don't even think 2.5 is a big number. The Fed certainly doesn't. They would welcome that kind of number. So, if you got a big risk-off event on the down, it could drive rates down. But more, I think, to the a restart of a true restart of the economy, maybe on the back of a vaccine, and possibly 21, the return of inflation. That's 2021, the return of inflation, because less stuff being produced, more demand, that should produce higher prices. That could get it going maybe later on this year or into next year.
So what does more bond volatility mean then? Can you give a couple more examples?
Yeah, so a lot of people ask this question that are basically not in the bond market. Okay, so there's no bond volatility, and we might get bond volatility, or rates might go up, or rates might go down. So what does that mean? I own Tesla options. Please tell me how that works in the economy. Well, if interest rates start to move higher or lower in a meaningful way, I think that the interpretation will be one that will affect all risk markets. I happen to believe that the bull market in bonds ended March 9th when they hit 33 basis points intraday. That is the 39-year bull market. The bull market started in 1980. And so I do think that I'd be surprised if we went through it. But if I'm wrong and we do find an event or series of events that could create a big enough bid in bonds to push them back down to 33 basis points, that would come by with higher volatility, which would signify something is seriously wrong with the economy. And I think that would show up in a big way in risk markets like stocks, that they would have an immediate and negative response to that type of event. On the flip side, if inflation returns, and the thing about the inflation story is, keep in mind, the risk-off story could happen right away. It could happen in a period, it could happen in a period of a couple of weeks. The other side of the story, the return of inflation, that will evolve over many months. It's not like a week from Thursday, we're all going to decide that there's an inflation problem. It doesn't come about that fast. But if we do, over the period of next several months, evolve an inflation story, here's inflation, it's starting to return, it's going up, I think that forces the Federal Reserve to rethink we're not going to raise rates in 3 years. I've been fond of saying that with the Fed buying $3 trillion of securities, they are dominating the bond market, and they've gotten rid of all of the volatility of the bond market. By the way, we've seen this exact thing happen in Japan, where they also do massive QE as well, too, that their volatility all but disappeared as well. But once there is an entity that is larger than the central bank, and that is the collective of the market. The collective of the market comes of the mind that inflation is returning. That is that the general price level goes up. The worst thing to own in that environment is a fixed income security. The amount of money you get every semi-annual payment is fixed. It's the same, but your purchasing power is reduced every single period. So you're constantly losing real purchasing value. You can buy less and less stuff with the same amount of securities. You don't want those securities. There will be massive selling of treasuries. Even if the Fed steps up with QE, yield curve control, and the like, and says, stop, we're not going to let interest rates move, the market can overwhelm them. The Bank of Japan does QE, as I mentioned, in a massive way. We've seen this happen in the Bank of Japan, that the market can run over the central bank. The ECB, the European Central Bank, does a version of QE as well, too. We've seen the market run them over as well. But the market has to get of one mind. You know, if there's a lot of different opinions, kind of like we have now, it's not going to overrun the central bank. But inflation, a return of inflation could. And if that's the case, that you get a higher inflation fear, say, evolving in the next year, and the market starts to sell off, and rates go up, 66 basis points in the 10-year now, let's say over 1 on its way to 1.25, to give you an idea of what kind of rate hike we're talking about. You would then possibly see the Fed be forced to change its opinion and maybe raise rates. On that final score, remember the fourth quarter of 2018. Chairman Powell gave a speech and he said, look, in 2019, we're going to reduce the balance sheet and it's going to be like watching paint dry. The market didn't like it. The market rioted. The stock market fell 3%. Dow was down 600 points during his press conference in December of 18 when he made that statement. Kept selling off from high to low, almost a 20% correction. 2 weeks later, he comes out on the DS at a speech, January of 2019 in Atlanta at the American Economic Association meeting, and he said, okay, remember that we're going to automatic pilot reduce the balance sheet, and it's going to be like watching paint dry. Forget it. We're patient, we're flexible. That's the wording he used. Threw it in the trash can. The Dow went up 1,000 points in 10 minutes after he said that, and 2019 never looked back. It turned out to be a huge, huge up year. So the Fed has shown that, yeah, they'll keep rates low and it's 0 for 3 years unless the market riots. And the riot of defining of the market rioting is a fear of inflation. Rates go over 1% on their way to 1.25, and then they might be forced to have to start thinking about raising rates sooner than they think, and that could help breed volatility in the market. And so that could be negative. So what did I just say? I said, if we have a risk-off event, rates go down a lot, that could be negative for risk markets. If we have inflation and the rates go up a lot, that could be negative for markets too. The sweet spot for risk markets is what we've had. Nothing. Sideways action, very low volatility, the bond market falling asleep, no one has to look at it. That's exactly what we've had, and that's what works for risk markets. So the minute you get volatility, I think it hurts risk markets one way or the other.
Jim, any final thoughts today on the bond market as we wrap up our podcast?
I remember the line of Jim Carville. He was a Bill Clinton advisor in 1994, and he said, when I want to be reincarnated, I want to come back as the bond. I don't want to come back as a 400 hitter. I want to come back as the bond market. The bond market scares everybody. The bond market is the big influencer in the room. It's been asleep. When it wakes up, and it will someday. It won't stay like this forever, I don't think. But when it wakes up, it will impose its will on all facets of financial markets. Right now, it's not, and that's why it's been helping this markets rally through this, through the spring and into the late. I'm sorry, through the summer into late summer, early fall. But I do think that once it starts going, it will be noticed by everybody. Oh, and last thing I'll say too, if you're watching me on YouTube, rest in peace, Gale Sayers, one of the greatest NFL players ever.
Absolutely. Thank you for your time today and your thoughts, Jim. Thank you, audience, for joining us today. As a reminder, Arbor Research and Trading is an institutional research and brokerage firm that produces innovative research across a broad range of global fixed income, equity, currency, and commodity markets. Bianco Research and Arbor Data Science are our two most prominent research offerings. For further information on Arbor Research, Bianco Research, and Arbor Data Science, please contact Gus Handler at gus.handler@arborresearch.com.